In March 2022, two brothers from Ohio checked their investment accounts on the same Sunday morning. Jake was 31. He had done everything right, maxed out his Roth IRA, set up automatic investments into S&P 500 index funds, bought a little Bitcoin because everyone said he should. He had been investing $800 a month for 3 years. His account showed $24,100. He had put in $28,800. He was down $4,700. His older brother Mike had invested the exact same amount over the exact same period. Different assets. Assets their grandfather had told them about before he died, assets that Jake had dismissed as outdated and boring. Mike's account showed $51,300. Same family, same income, same amount invested. Jake was down $4,700, Mike was up $22,000. Jake spent that entire Sunday researching what Mike owned. What he found made him sick. These four asset types had done the same thing in every major crisis going back 100 years: 1929, 2008, 2020, 2022. Every single time markets collapsed, these same assets surged, and almost nobody owned them, less than 2% of investors. Jake had been playing with half a playbook, the version they hand out to people they expect to lose. My name is Ban, and I spend way too much time analyzing historical market data, tracking where wealthy families actually put their money when nobody's watching. We are not talking about crypto. We are not talking about meme stocks. We are talking about the four specific asset categories that have protected and grown wealth through every economic catastrophe of the last century. Assets most financial advisors will never mention because they make no commissions selling them. If this matters to you, hit subscribe right now. I'm going to keep breaking down patterns that will really help to understand the bigger picture. Hit that like button. It tells the algorithm to show this to more people who need to see it. Here's the thing about economic crises that most experts get completely wrong. They treat market crashes like random natural disasters, unpredictable, unavoidable, equal opportunity destroyers. But that is not what the data shows. The data shows something far more interesting and far more useful. I call it the crisis transfer theory, and once you understand it, you will never look at your portfolio the same way again. Let me show you what actually happens during every economic depression.
Phase 1 is the collapse itself. Asset prices crater. Stocks, real estate, commodities, everything tied to economic activity plummets. Credit freezes. People panic. Your 401k drops 40%, and you start wondering if you will ever retire. But then comes phase 2, the flight to safety. This is where it gets interesting. Smart money, institutional investors, pension funds, the people managing billions of dollars, they have to put their capital somewhere. They cannot just sit in cash because cash loses value to inflation. They cannot stay in stocks because that is where the bleeding is happening. So they move into assets with 3 very specific characteristics. Characteristic 1 is tangible scarcity, physical assets that cannot be printed or created out of thin air. Characteristic 2 is essential utility, things people need regardless of what the economy is doing. Characteristic 3 is historical precedent, assets that have survived every previous collapse. Then comes phase 3, the wealth transfer. While everyone else is panic selling at the bottom, informed investors are accumulating these specific assets. By the time the economy recovers, they have doubled or tripled their wealth, not through speculation, through strategic positioning before the crisis became obvious. This is not theory. This is documented history, and I'm going to prove it to you with hard numbers. But first, let me show you how bad the alternative is. Here is the S&P 500 during 3 major economic crises. 1929 Great Depression, down 89%. If you had $100,000 in stocks, you were left with $11,000. 2008 financial crisis, down 57%. Your $100,000 became $43,000. 2020 COVID crash, down 34%. Your $100,000 became $66,000. And 2022, down 19%, while inflation ran at 9%. Your purchasing power got destroyed from both directions. Devastating.
But now look at this. While the market was imploding during each of these crises, 4 specific asset classes were doing something remarkable. They were not just holding their value, they were appreciating. During the Great Depression, one of these assets gained 474%. During 2008, another returned 14% while everything else burned. During COVID, one delivered 16% returns. So what are they? Let me break down each one.
Asset number 1, gold mining stocks. Not physical gold, the companies that dig it out of the ground. During the Great Depression, 1929 to 1933, while the Dow Jones crashed 89%, Homestake Mining, America's largest gold producer at the time, gained 474%. That is not a typo. 474% during the worst economic collapse in American history. In Canada, Dome Mines gained 558% during the same period. The entire economy is collapsing, banks are failing, unemployment hits 25%, and gold mining stocks are quintupling in value. Fast forward to 2008, the S&P 500 loses 57% of its value. But look at what happens to gold miners from the March 2009 bottom to the September 2011 peak. The VanEck Gold Miners ETF gained over 200%. The mechanism is simple economics. When fiat currencies lose credibility, governments and investors flee to gold. The gold price rises, but the cost of extracting gold stays relatively stable. Mining companies' profit margins explode. Plus, you get leverage. When gold goes up 50%, gold mining stocks often go up 150% or more. Now here's where I need to be honest with you, because most financial content leaves this part out. These same gold mining stocks crashed 80% from 2011 to 2015. They are extraordinarily volatile. They are not a buy and hold forever asset. They are a crisis asset. You accumulate them when nobody wants them, and you have an exit strategy. Only about 1.3% of U.S. investors own gold mining stocks today. Wall Street makes no money selling you miners. They would rather keep you in index funds where they can charge management fees forever. Think about that. An asset that gained 474% during the Great Depression, and less than 2% of investors own it. That is not an accident. That is a feature of how the financial industry works. Now here's where it gets darker. Asset number 2, long-term Treasury bonds. I know, bonds sound boring. Stay with me because the math is remarkable. During the 2008 financial crisis, while stocks were losing 57%, Treasury bonds returned 14.3%. In November 2008 alone, while stocks were in free fall, long-term Treasuries gained nearly 15% in a single month. The mechanism here is called flight to quality. During a crisis, institutional investors, pension funds, insurance companies, foreign governments, they must park their money somewhere considered safe. Where do they go? U.S. Treasury bonds. As demand surges, bond prices rise. As bond prices rise, yields fall. Anyone who already owns those bonds sees massive capital appreciation.
But here's the critical part most people miss. You need to own them before the crisis hits. Once everyone is panicking, the gains have already happened. The trade is positioning, not reacting. You can buy individual Treasury bonds directly from treasurydirect.gov, or you can buy the TLT ETF, the iShares 20-plus year Treasury bond fund. When the next recession hits, TLT has historically jumped 20 to 40%. Now you might be thinking, wait, did bonds not get crushed recently? Yes. In 2022, long-term treasuries had their worst year in history, down over 30%. That happened because of inflation. Bonds are your deflation hedge, not your inflation hedge. If inflation accelerates faster than expected, bonds get destroyed. This is why you need multiple crisis assets, not just one. Different assets protect against different types of collapse. Which brings me to asset number 3, farmland. This is the asset Bill Gates has been quietly accumulating. He now owns over 270,000 acres of U.S. farmland. When the fifth richest person on Earth is buying something that most investors ignore, you should probably pay attention. Here's what the data shows. According to the NCREIF Farmland Index, U.S. farmland provided a 15.8% return during the 2008 Great Recession, while the S&P 500 was down 57%. Between 2000 and 2020, farmland returned an average of 11.5% annually, with lower volatility than stocks. The mechanism makes sense. They are not making more farmland. Productive farmland is actually shrinking due to urbanization and climate change. Population is growing. Everyone needs food. And unlike gold, farmland generates cash flow through crop yields. Even if land values stagnate, you are earning 3 to 5% annually from harvests. Now, I need to add some historical context here because intellectual honesty matters. During the Great Depression, farmland actually declined significantly in many regions. Farm income fell 50 to 70%. Land values dropped 30 to 50% in some areas. The Dust Bowl was devastating. But here's the key insight. The land itself survived. It transferred to stronger hands. And in the decades following, those who held productive farmland rebuilt generational wealth. Farmland is not a crisis moonshot like gold miners. It is a steady, income-producing store of value that tends to hold up when financial assets collapse. You can buy physical farmland if you have significant capital, typically $500,000 minimum. Or you can use platforms like Farm Together or Acre Trader, though fair warning, those often require you to be an accredited investor with a high net worth. But for the rest of us, there's a back door. You can buy farmland REITs directly on the stock market. Look at Gladstone Land, ticker LAND, or Farmland Partners, ticker FPI. These companies own thousands of acres of productive farmland. You can buy a share for less than $20, no accreditation needed, and you get paid dividends from the rent farmers pay them. It's the easiest way to add dirt to your portfolio without getting your hands dirty. Asset number 4. Consumer staples stocks. These are the companies that make products you buy regardless of the economy. Toothpaste, toilet paper, soap, coffee, beer. The boring stuff nobody talks about at parties. Here's the data. During the 2007 to 2009 crash, the consumer staples sector, ticker XLP, was one of the best performing sectors. While the S&P 500 lost 57%, consumer staples fell only 28% and recovered much faster. Walmart gained 18% in 2008 while everything else was burning. McDonald's stock went up 6% during the crisis. Recession or depression, people still need to brush their teeth. They still need groceries. They still need cleaning products. Companies like Procter & Gamble, Coca-Cola, Walmart, Costco have stable earnings, strong dividends, pricing power to pass inflation to consumers, and global diversification. Now here's where I need to be honest again. These stocks did not double during the crisis. They just declined less. That might not sound exciting, but think about the math. If you're down 57%, you need 132% gain just to get back to even. If you're only down 28%, you only need 39% gain to recover. Recovering faster means compounding sooner. The boring advantage is real. Wall Street analysts hate consumer staples during bull markets. Too boring, not enough growth. But that's exactly why they outperform during crises. Boring is beautiful when everything else is chaos. You can buy them individually or buy the Consumer Staples Select Sector Spider Fund, ticker XLP, which holds a diversified basket of 33 consumer staples. Now here's why this matters to you specifically. If you have a 401k, an IRA, a brokerage account, or any retirement savings, you are almost certainly overexposed to the exact assets that get destroyed during crises. The standard advice is buy index funds and hold forever. That advice works great during 40-year bull markets. It works terribly during the 18 to 24-month periods when markets crash 50% or more. Let me show you what happens to your money in a standard portfolio during a crisis.
Say you have $150,000 saved, a typical 60-40 portfolio, 60% stocks, 40% bonds. A crisis hits. Stocks drop 50%. Your equity portion goes from 90,000 to 45,000. If it is a deflationary crisis, your bonds help. If it is an inflationary crisis like 2022, your bonds drop too. You are now looking at a portfolio worth maybe $80,000 to $90,000. You have lost $60,000 to $70,000. Meanwhile, someone positioned in these four crisis assets is watching their gold miners surge, their treasury bonds appreciate, their farmland pay dividends, and their consumer staples hold steady. They are not panicking. They are accumulating your assets at 50 cents on the dollar. When the recovery comes, you are still trying to get back to break even. They are up 60% from their crisis lows. This is not theory. This is what happened to Jake and Mike. Same starting point, radically different outcomes. The only difference was which playbook they were using. Here's the uncomfortable truth. We are looking at elevated recession probabilities right now. The yield curve has been inverted. Corporate debt levels are at historic highs. Commercial real estate is showing serious stress. Consumer credit card debt just hit record levels. I'm not predicting a crash. Predictions are useless. But I am saying the conditions that preceded previous crashes are present right now. The question is whether you are positioned for what might happen or just hoping it does not. So what do we actually do with this information? Look, the first thing we need to talk about is protecting what you already have. Because here's the reality. You have spent years building whatever portfolio you have right now. You have sacrificed. You've been disciplined. The last thing you want is to watch it evaporate because you were only prepared for one type of market. If I were in your position, I would be looking at moving 10 to 20% of my portfolio into these four asset classes. Not tomorrow necessarily, not in a panic, but deliberately over the next few weeks or months. Here's what the smart money is already doing. They are taking positions in gold miners through GDX, the VanEck Gold Miners ETF, or through individual miners like Newmont and Barrick Gold. These are not speculative penny stocks. These are established companies that have survived multiple economic cycles. For Treasury exposure, they're looking at TLT, the iShares 20-plus year Treasury bond fund. Or if you want to go direct, you can buy Treasury bonds yourself through treasurydirect.gov. No middleman, no fees. For farmland, you don't need to go out and buy 100 acres. You can use that back door I mentioned earlier. Tickers like LAND and FPI give you liquid, tradable exposure to agricultural real estate. It's the same asset class the billionaires are buying, broken down into shares you can buy on your phone. And for consumer staples, you can either pick individual companies like Procter & Gamble, Costco, Coca-Cola, Walmart, or just buy XLP and get the whole basket in one trade. The logic here is simple. You're not betting against the economy. You're not predicting a crash. You're just making sure that if things go sideways, you have positions that benefit from that chaos instead of just positions that suffer from it. Think of it like insurance. You don't buy fire insurance because you are certain your house will burn down. You buy it because the cost of not having it if something does happen is catastrophic. Now here's where it gets interesting. While everyone else is panicking about recession risk, there's actually an opportunity sitting right in front of us. These crisis assets are cheap right now. Gold miners have been beaten down. Consumer staples have underperformed tech for years. Nobody is talking about treasury bonds because yields have been rising and prices have been falling. This is exactly what the Rockefellers figured out during the Great Depression. This is what certain family offices understood in 2007 before the crash. The time to buy crisis assets is when nobody wants them, when they're out of favor, when financial media is telling you to chase AI stocks and Bitcoin. The smart money doesn't wait for the crisis to start. By then, these assets have already repriced. The gains have already happened. The opportunity has passed. Right now, you can buy gold mining stocks at valuations that would have seemed absurd 2 years ago. You can buy long-term treasuries that will surge 20 to 40% if we enter a deflationary recession. You can access farmland that throws off steady income regardless of what the stock market does. This window will not stay open forever.
When the next crisis becomes obvious, when it's on the front page of every news site, when your coworkers are talking about it at lunch, everyone will suddenly want these assets. And the people who positioned early will be the ones selling to the people who waited. But here's the thing. This situation is fluid, so you need to be watching for signals that tell you when to act more aggressively and when to pull back. The yield curve is the first thing I would watch. When short-term interest rates are higher than long-term rates, that is called an inversion, and it has preceded every recession in modern history. We have been inverted, but here's the key. The recession does not start during the inversion. It starts after the curve normalizes. When you see the yield curve uninvert, when short-term rates drop back below long-term rates, that is your cue that the clock is ticking. Historically, recessions have followed within 12 to 18 months of that normalization. The second signal is credit spreads. That's the difference between what corporations pay to borrow money versus what the government pays. When that spread is tight, investors are confident. When it starts widening, that means investors are getting nervous about corporate defaults. If you see credit spreads jump by 50 basis points or more in a short period, that is risk being repriced in real time. That is your cue to accelerate your defensive positioning. The third signal is unemployment. The Fed watches this obsessively. When unemployment starts ticking up from cycle lows, even by a small amount, the Fed typically responds by cutting rates. But here is the pattern nobody tells you. By the time unemployment is rising, the recession has usually already started. The Fed is always late. So when you see that unemployment rate start climbing, that is not the beginning of the problem. That is confirmation that the problem is already here. Keep an eye on all three: yield curve normalization, credit spread widening, unemployment ticking up. When 2 or 3 of these signals flash at the same time, that is when you want your crisis positioning to be fully in place. Now, I am not saying you need to do all of this tomorrow. You do not need to panic sell your index funds tonight and pile into gold miners. That is not the move. But what I am saying is you need a plan. Because when this thing moves, it is going to move fast. Look at March 2020. The S&P 500 dropped 34% in 23 trading days. If you did not have a plan before that happened, you were just reacting. And reacting is how you sell at the bottom and buy back at the top. The people who came out of 2020 in great shape were not the ones who predicted the crash. They were the ones who had already positioned for the possibility of a crash. They had their crisis assets in place. When markets cratered, they were not panicking. They were calm. Some of them were buying. That is the difference between Jake and Mike. Mike was not smarter. He was not luckier. He just had a plan that accounted for bad times, not just good times. Let me bring this back to where we started. Jake spent that Sunday morning in 2022 staring at 2 screenshots. His portfolio down 4,700. His brother's portfolio up 22,000. Same family, same money, same time period. Completely opposite results. After that day, Jake started repositioning. He did not go crazy. He did not make dramatic moves. He simply started allocating a portion of his portfolio across these 4 asset classes: gold miners, treasury bonds, farmland, consumer staples. By the end of 2023, his overall portfolio had recovered, but more importantly, he understood something he had not understood before. The market is not one game, it is 2 games. The bull market game rewards growth, technology, momentum. The crisis game rewards safety, scarcity, essential demand. Most investors only know how to play one game. They win during the good times and give it all back during the bad times. The investors who build lasting wealth know how to play both games. They have positions for prosperity and positions for crisis. Jake's grandfather knew this. He had lived through the Great Depression. He watched his neighbors lose everything while certain families thrived. He spent his whole life trying to teach his grandchildren the pattern. Mike listened. Jake did not, until that Sunday morning showed him the cost of not listening. You are in the same position Jake was. You have been taught one game. You have been given one playbook, and that playbook works great until it doesn't, until the crisis comes and you realize you were never taught how to protect yourself. The 4 assets I showed you today are not secrets. They are documented in historical records going back 100 years. Homestake mining's performance during the Great Depression is public information. Treasury bond returns during 2008 are in Federal Reserve databases. Farmland indices are published quarterly. Consumer staples performance is tracked by every major financial data provider. This information exists, it's just not advertised, because the financial industry makes money when you buy and hold index funds through every crash, paying management fees while your portfolio bleeds. They do not make money when you own assets that protect you during crises. The $93 trillion in U.S. household wealth is not protected by hope, it is protected by positioning. And right now, less than 2% of investors are positioned in the assets that have historically protected wealth during every major crisis of the last 100 years. Do not interpret current market stability as safety. Every major crash in history was preceded by a period when everything seemed fine. The smart money moves before the crisis is obvious, not after. Here is what I want you to take away from this. First, audit your current portfolio. What percentage do you have in assets that surge during crashes versus assets that collapse? If the answer is mostly collapse assets, you have work to do. Second, start researching these 4 asset classes. You do not have to buy anything today, but understand what gold miners actually are. Look at TLT's historical performance. Explore farmland platforms. Learn about consumer staples companies. Get educated so you can act quickly when you need to. Third, start watching those signals: the yield curve, credit spreads, unemployment. Set up alerts, check them weekly. When the data shifts, you want to know. The next crisis is coming. It always does. The only question is whether you'll be positioned like Jake before that Sunday morning or like Mike.
If this changed how you think about your portfolio, if you finally feel like someone showed you the second playbook, do me a favor. Share this with someone who needs to hear it. A friend who has been bleeding money doing everything right. A family member who thinks index funds are the only option. Someone who deserves to know that there is another way to play this game. This is Ban. Stay sharp out there.